Coming up on Your Money and Your Life, what does $1 million buy you in property? Sneaky supermarket tactics to make you spend more? Should parents have to leave an inheritance? Plus, in Kochie's Budget Challenge, Melbourne couple Jane and Vince discover how to hack their home loan. G'day and welcome to Your Money and Your Life, the show that's all about saving, spending, investing and enjoying your money. My mission is to help you make the very most of your money. We're going to kick off with Kochie's Budget Challenge. Each week, with the help of the team at Compare the Market, we dig into real families' biggest bills to see if they could be on better deals. We found tens of thousands of dollars of savings last season, and we've got even more coming up. Let's start with Jane and Vince.
We're at a stage now we're looking at the most important resource, which is our time, and our money will help fund that. Each stage of life gives you an opportunity to do more or you need to change with time, being in a good financial position to help us have the lifestyle that we want. Hi, I'm Jane.
Hi, I'm Vince, and we live in Brunswick, Melbourne. Absolutely adore living in Brunswick, the fantastic vibe, bars, the restaurants. We're really looking forward to meeting Kochie if he's able to help us save some money, which will help fund our exotic lifestyle of croissants and coffee.
So talk to us about the strategic goals that you've set yourself. What are you hoping for in the future?
Being where we are now, we've come a long way. We're mature, we've got some good assets behind us. We've kind of got to that 50 stage where we've got a crossroads where we've both gone into our own businesses. Vince is a more established one and is going through that process, and I'm in the startup side where we've got this app coming through.
What's it called?
It's called Obi Money. It's a really cool little app that helps people to plan their budget and spend better with their money and create a better life.
That's fantastic.
If I look back at my early 20s, I left home early, I had no idea what I was doing, and I was in a lot of trouble pretty quickly. Understanding that I didn't have to be meant that I've just spent probably the backdrop of my life trying to understand how money works, how I can use it better, how it can help me, and how I can not kind of be a prisoner to it. And I think we've done that really well.
By far, our biggest expense would be our home loan. It's such a big component of our outgoings.
Okay, let's get started. The team at Compare the Market have gone through your bills. Now remember, these are just thought starters. You've got to make your own decisions. Home loan first. Big one.
Yes.
Currently paying 6.64%.
Yeah.
Have you been following the interest rate cycles really closely? Are you seeing it in your repayments?
Definitely seen it gone up. As much as I know that there's things we should be doing, there is also a big list. So getting to all of those things. And
The team at Compare the Market have gone through the home loan, and it's not just about rates. It's not just about getting your own rate cut rather than waiting for the Reserve Bank to cut rates. By negotiating, you can get a better rate.
Yeah.
But also, how long have you been here for in this place?
Just on 10 years.
10 years.
Okay, because in that period, its value would have gone up enormously.
Yeah.
And one of the things banks look at when giving you a rate on your home loan is your LVR, loan to valuation ratio. And if your equity has gone up in this place, you become a safer bet. The bank gives you a lower rate because there's less risk. And Compare the Market team have found a rate about 0.5% less that you could easily switch to. Now that's 2 Reserve Bank 0.25% interest rate cuts.
Wow.
Without the Reserve Bank doing anything. You've got it on your own. That'll reduce your repayments by about $600 a month.
Yeah, that's significant.
A month. But that's over $7,000 just on the home loan.
Wow, for the year.
You can get going through.
Yeah.
Let's stay with the house and look at home and contents insurance. It's a big whack, isn't it?
Yeah.
Are you surprised how much you pay in home and contents insurance?
I am. That's a lot.
It's a grudge payment, isn't it, Vince? I hear your pain.
There's nothing in my house that I can afford to lose. I want to keep everything I've got. And unfortunately, I suppose some of the insurance companies know that, and they play on your emotional heartstrings because
It is peace of mind,
Yeah.
isn't it?
Again, we don't look at it, not enough. The biggest problem is all the policies come in your email, they turn up, you haven't got time to look at them, so we haven't done it.
Yeah. Well,
Yeah.
we
Yes,
we
we're
put
doing
your
it.
home and contents through the Compare the Market ringer.
Fantastic.
They've come out without changing your excess.
Yeah.
Found a similar policy which would reduce your premium by $295
Okay.
over the year. That's if you pay annually
Yeah.
rather than monthly.
Yeah.
But if you're comfortable increasing that excess from $500 to $1,000,
Yeah.
then the premium will be cut by $500.
Jeez,
A
okay.
bit more than $500.
Yeah.
So we've covered the house, home loan, home and contents insurance, potential reduction up to around $7,500,
Jeez, yeah.
but more to come.
Oh, great.
After the break, a new alternative to shares for generating passive income. Welcome back to Your Money and Your Life. Well, is the share market the be-all and end-all for generating passive income? You know I love shares, but there are other ways to invest if you're not up for riding the volatility of the share market and prefer a more reliable monthly income. Aussies can now invest in what's called global private credit, one of the world's fastest growing asset classes in recent years. ASX-listed Pengana Capital Group is bringing this opportunity to our shores through term accounts like Term Plus. Pengana Chief Executive and Managing Director Nehemiah Richardson is here to unpack it for us. Nehemiah, good to see you. Welcome.
Thank you, David.
Global private credit has grown so much over the last couple of years. What is it? Explain it to us.
Yeah, so I guess the first thing to say, because I think it's not something that Australian investors are, or the average investor is not familiar with. And I think that's because, well, let me start at the outset. It's lending. I think everybody knows what loans are.
Yep.
Okay, and it's loans that are the key driver of global private credit. But then if you look at our market, 90% of our loans in this country are underwritten by banks, 10% by private credit.
Right.
And then if you then go and look at global, the whole thing is flipped around. Okay, so 85% of corporate lending in the mid-market of the US and Europe, very large markets, is done by global private credit managers. 85%, 15% by banks. And that continues to grow.
Nehemiah, why is global private credit only just now being able to be accessed by average Australians?
Because historically, it's been the province of, say, the big end of town. So big institutions, your industry super fund. In fact, if you're in an industry super fund, I'd be flabbergasted if you didn't have part of your portfolio invested in global private credit.
Right.
Okay, but it hasn't been something that the average person can invest in. And what we did when we set up Term Plus was we really wanted to democratize that asset to give individuals the same quality that you can get as an institutional investor in a very easily accessible, digestible form.
So what's the minimum investment?
So the minimum investment is $2,000, and it takes, I as an investor in it, through my, personally, it took me 2 minutes to open an account. Through my self-managed super fund, it took less than 10 minutes to open an account. So very easily accessible. One of the great things about that income is it's floating rate, meaning it's a fixed percentage above the RBA cash rate. So for 1 year money, that's 3% over the RBA cash rate, which is more than what I can get out of my bank account.
Okay, so tell us the difference between investing in shares. What are the different, how does it fit in your portfolio?
So if you're an investor who says, I don't really want the ride, or I want part of my portfolio to be very stable, and you get monthly income paid every month from the interest payments that come from that portfolio, it's a really nice way of diversifying your portfolio and getting peace of mind while still getting a really nice return.
Okay, give us an example of how a customer has benefited from going there rather than the other alternative income generating alternatives.
So I'll give you my personal example, okay, because at the end of last year, I sold my house in Melbourne because we're downsizing, my wife and I. And at some point, we're going to go back into the property market, for something that's more suitable for us. And so one of the things that was very important to me for part of the proceeds was to have it be very capital stable. I did not want to take downside risk on my capital, and I wanted to maximize the return on it. So keeping it in a bank account was just not enough for me. Yep. The interest rate was too low. So when I looked at what my alternatives were, and I guess you could say I eat my own cooking here, because what I really like is the yields that you get. So I'm an investor in Term Plus specifically because of the capital stability, that I see in it, and the really nice income that I get.
Nehemiah, thanks for joining us. Appreciate it.
Yes, thank you very much, David.
No matter your age, income or financial goals, quality financial advice may help you increase your wealth, save on tax and secure the lifestyle you want. There is evidence that people who retire with advice have better retirement outcomes. According to the Brighter Super and Investment Trends Retirement Income Report, 55% of pre-retirees said they felt more prepared once they'd had information or guidance to act upon. Talking to a financial advisor can help you explore how to grow your super to maximise your retirement savings, create a plan to achieve a comfortable retirement, and protect you and your family in the event of death, illness or disability. Through your super fund, you may be able to access online tools such as calculators that help you understand when you can retire and how much money you'll need. You may also get general advice through your fund, which could be covered in your membership fee. Or if you need more comprehensive superannuation or retirement advice tailored to your personal situation, this may also be available for a fee. It's never too early or too late to start planning for a brighter financial future. Coming up next, how far $1 million stretches now in property. Welcome back to Your Money and Your Life. Now, the price of Australian property has reached new dizzying heights, with more than a third of homes nationally valued over $1 million or more. According to figures from Cotality, the old CoreLogic, regionally, about 20% of homes are valued over $1 million or higher as well. In capital cities, it's over 41%, while in Sydney, almost 2/3 of homes are past the $1 million threshold. To analyse the figures and offer hope to those yet to break into the market, Ray White Chief Economist Nerida Coddesby joins me now. Nerida, the $1 million price tag has become increasingly standard. Give us some examples of the big leaps up to that level.
Well, if you think 10 years ago, Sydney only had a median of around 890,000. So it has been an incredible change. It's now sitting at 1.6 million. Gold Coast, 5 years ago, the median was sitting at around 750,000. It's now at almost 1.2. And then the really big growth market of Adelaide, we were seeing a median of around 500,000 10 years ago. It's 900,000 now. It'll probably hit $1 million in about 12 months.
Wow. The property league table, if you like, has changed a lot, isn't it? Melbourne has dropped right down, been overtaken by Brisbane and Adelaide and soon to be Perth. Why has Melbourne dropped so much in that median value?
So Melbourne had a really tough time during the pandemic. People were locked down for a long period of time. It did lead to the economy growing quite slowly over that time period. Since then, Melbourne has continued to attract a lot of people, but to pay back a lot of the COVID debt, they've had to tax property quite significantly. So as a result, we have seen a lot of investors in particular sell out of the market. And so there has been a reduction in rental properties, and prices have been far more stable and actually come back compared to markets like Adelaide, which are moving very, very quickly at the moment.
You mentioned Brisbane at the other end of the scale. 10 years ago, only 3% of properties with that $1 million price tag, now 40%. Incredible. Where's that come from?
Population growth. So southeast Queensland has been attracting a very high share of interstate movement in particular. So it's not just Brisbane, it's really the area extending from Byron Bay up to Gold Coast, around to Brisbane, up to Sunshine Coast.
Where are the regions, the suburbs, that you can see the biggest growth to get above that $1 million tag in the near future for people who want to get their leg aboard the property market?
Yeah, so definitely Adelaide is a market to look at. So particularly the inner suburbs, a lot of them are over $1 million, but generally if you go out to the next ring, the middle ring, you start to see suburbs that are sitting at sort of that $800,000, $900,000 median. Perth, very similar. You're pretty much priced out of the western suburbs, but as you start to move a little bit more inland, you start to get a few cheaper options. Similarly in Brisbane now, if you're looking at places like New Farm, the median is well in excess excess of $2 million, but if you start to move a little bit out, sort of 5 to 10Ks, you can get far more affordable options.
Those smaller capital cities, are they more susceptible to a bust at the end of this boom? Or do you think it's going to be a steady trajectory upwards?
Depends where you are. I mean, it depends how mixed the economy is. So traditionally, Perth, for example, has been very boom-bust according to mining cycles, but it does seem to be far more sustained this time. So partly driven by the fact that population growth is continuing to happen. Also, a little bit more of a diverse economy, still very dependent on mining, but then even mining is becoming more variable, not just iron ore, it's moving into green energy minerals, so that's helping. Other end of the scale, we've seen places like Hobart actually come back in pricing. So Hobart was a really, really hot market leading up to the pandemic, but just has failed to attract a lot of people in the same way it had been. And as a result, prices have moved back a little bit.
All of the home buyer grants that are out there at the moment, which are the most useful, do you think?
Look, I think it'll be the 5% deposit scheme, and the reason being it applies to both new and existing homes, and it does allow people to get into the market a little bit quicker. So I think it'll be the most popular. There are a lot of schemes available. There's a super saver scheme where you can save in your superannuation to buy a home and pull that money out and use it as a deposit. But ultimately, I think it will be the 5% deposit scheme. It's a little less complicated than some of the other schemes available.
Okay. All right, Nerida, great advice. Good to see you again as usual.
Thanks for having me.
Still to come on Your Money and Your Life, how to spend less at the supermarket in this cost of living crisis. Now to a potential threat facing every Australian shopper's hard-earned dollars. Have you ever found yourself getting home from a grocery shop having spent more than you'd planned on things you didn't even need? It's called supermarket psychology, and we're all at risk of being sucked in. It happens from the moment you step foot in a supermarket. Your senses are targeted and impulses tapped into. Retail guru from the University of Sydney, Lisa Asher, knows the playbook all too well.
Supermarkets, they're in the business to serve their customers and to help their customers find what they're looking for, but then also entice them to buy other things.
But in this cost of living crisis, we all need to wake up. So I'm pulling back the curtain on the top tricks and tactics used by a supermarket near you, starting with end-of-aisle promotions. Manufacturers pay big bucks to put them here. The discounts are hard to ignore and easy to grab.
Generally, they're half price. Or they're 2 for 1, or buy one, get one free, and they are discretionary items that we don't need.
Essentials at the back. Staples are normally spread out, forcing you to go through as many aisles as possible and stay longer in store. Eye level is buy level. You're more likely to buy something right in front of your eyes, and that's more often where the expensive items are found. Research from Compare the Market has found the average Aussie is forking out an extra $1,000 on groceries compared to last year.
We know that grocery bills are one of the biggest stresses.
But there are ways to avoid getting stung and stick to your budget. Research bargains before you shop. Buy essentials first. Ditch the trolley and keep an eye on prices. If an item scans incorrectly at the majors, guess what? You get it for free. Switching from brand names to generics is another way to save big.
What you might find is that sometimes they're manufactured under the same roof as your favourite brand name products.
So there you have it, how to beat the grocery giants at their own game so you can keep more money in your pocket. In this week's Word on the Street, we asked whether parents should feel responsible for leaving an inheritance for their children.
They like to threaten me and say that they're going to spend all the inheritance and go to Greece every year, but I would like, if they did, keep some aside for me.
Go wild. They've worked hard for it, let them spend it.
Yes, I think parents should feel responsible for leaving an inheritance. Otherwise, I think it does create a mess for some family, right?
I think with inheritance, it's always a divisive topic, but I think it's up to the parents to decide what they want to do with their money.
For my own children, yes, I would like to leave them something because, cost of living's hard, housing, median house prices are, over $1 million, so they'll need a head start in life.
I know our children are going to get a leg up, but I don't think parents should be obliged to help their children out. I mean, obviously, there'll be a lot of parents who just can't do it.
I'd definitely love to leave my 2 children something. I want them to have as much advantage as they can, more so than what I had. So I want to give them that leg up if possible. But equally at the same time, it's their call, and I'll have that conversation with them when the time comes.
Well, that's it for today. I hope you've enjoyed this episode of Your Money and Your Life. For all the latest money and investment news that you need to know, go to ymwhale.com.au. And while you're there, subscribe to my free email newsletter, which is delivered to your inbox every Friday. Thanks for joining us. Next week on Your Money and Your Life, how on track are you for retirement? We ask pre-retirees some key questions. Tips to better protect your inheritance from a big tax hit. Is bundling your bills always the best way to save? Plus, in Kochie's Budget Challenge, even more savings on the table for Jane and Vince.